Hey, we're back. Welcome, guys.
Woo! Morning. It's good to be back.
Don't call it a comeback, right? So welcome, everyone, to our DAT weekly market update. Apologies for some of our technical difficulties over the past 2 weeks. Rest assured, our team is working very hard to get that all sorted out. And as you can tell by the fact that we're here, we are making progress. So this is our update for February 9th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by Dean Croke, who's our Principal Industry Analyst, and Ned Damon, who is our Principal Data Scientist. Welcome, guys.
Glad to be here.
Yes, we can't use any of our Groundhog Day material that we had prepped for last week, which is a huge bummer.
I know. We really worked on those jokes.
Yeah. But anyway,
late night writers room.
It's only 5 now, so we'll get through it. So for those new to the show, or for those returning, we're here every Tuesday at 10 o'clock Eastern talking about the freight markets, what's going on, trends that we're seeing, and things that we think are important to share with you all. We have some really exciting stuff planned over the next few weeks. We're going to be talking to one of the largest freight brokers, doing some really innovative stuff, talking about pricing, business intelligence, and navigating volatility. We also have a conversation queued up with a specialty and flatbed carrier local to my area in Ohio. And we crowdsourced some questions, and we had some questions of our own, just given how much interest there is in that specialty market. So I'm really excited to share that with everyone. So I'm going to move us into our key points of the week. But just as I always call for questions at the beginning, and we'll remind you towards the middle, if you have any questions, I know it's been a couple weeks since we've talked, go ahead and drop them into the comments or chat below. Those will get forwarded over to us, and we will do our best to answer as many as we can at the end. So with that, I'm going to go into key trends that we're watching. So spot rates are finding support at current levels. We've been talking about support levels quite a bit. It's kind of settling in that, I think, 204, 205. Dean will correct me if I stray here in a minute. And they just seem to be looking for direction. Ned's going to show some really interesting stuff on the models that seem to be giving us the same feedback. Spot load post volumes up 5% week over week and more than double year over year. It's really kind of hard. The year over year comps all year are going to be really funky, right? So if you think about where we were this time last year, COVID was still essentially very limited, if at all present in the United States. It was just in Washington and a few other areas. So freight was very, very slow this time last year. This is before things sort of went crazy. The Freight Market Intelligence Consortium 2020 shipper contract volumes are up about a point for dry vans and down 6% for reefers. I think weather is a big story in the Great Plains, Midwest, and Great Lakes. And then peak shipping for Valentine's Day, roses landing in Miami. And Dean will have more to cover for that. And honestly, at that point, I'm just going to turn it over to Dean because I think he has a ton of stuff to share. So Dean?
Yeah, thanks, Ken. Yeah, starting on weather, I think I just want to touch on that. I mean, we're starting this week with some of the coldest air that's hitting the US. Yesterday was fascinating. 80% or about 280 million Americans woke up to sub-zero temps. In fact, up in the icebox of the US in International Falls in the Duluth market, temps were as low as minus 53. You typically see a lot of shippers move dry van freight in reefers, so it pushes up volumes in those markets for refrigerated trucks. In that Duluth market, reefer volumes are up 32% last week and rates up 6%. So we're also seeing a lot of clogged freight networks around the Northeast, successive snowstorms. I noticed this morning some large truckload carriers issuing service disruption notices for their customers on a 24 to 48 hour range. So we can expect more disruption and possibly more volumes in the spot market this week as shippers look to move some of that volume. Load board activity, starting off with dry vans. Last week there was some weather impact. We think volumes increased about 7% week over week, almost double this time last year. Capacity remained largely unchanged. So the load to truck ratio stayed pretty much the same as it was the week before at 4.55. The Arctic temps blasting the top third of the country pushed up reefer volumes by 13% week over week. As a result, the load to truck ratio moved up to 9.95. And in flatbed, both load posts and equipment posts increased by 2%. So again, the load to truck ratio remained unchanged at around 53 loads per truck. Lots to cover on the market condition indexes. In the dry van market, load posts in our top 10 markets increased by 5%. but capacity remained fairly flat. Load rates only increased by about 1 cent per mile. Lots of volume coming into the East Coast in Savannah and New York. Outbound volumes increased last week. Elizabeth, New Jersey, the number one market, up 7%. Spot rates also increased by 3 cents a mile to $1.90 for loads out of the New York area. In Atlanta, a lot of that Savannah volume makes its way into the Atlanta market as a distribution center. Volumes increased 6% week over week. Spot rates up 2 cents to $1.97. And on the West Coast, outbound volumes dropped in Los Angeles by 14% and 8% in nearby Ontario. But in contrast to previous weeks, capacity tightened slightly. In both markets, rates were up 2 cents a mile to $2.35 and $2.43 respectively for Los Angeles and Ontario markets. So brighter news on the refrigerated sector. Our focus is in Florida, which is basking in 80-degree temperatures today, in contrast. It's an important week this week, not only because a lot of volume in roses for Valentine's Day, but it also marks the start of the peak shipping season for strawberries, which ramps up this week. Florida produces the majority of the winter strawberry crop. According to USDA data, about 76% of all strawberries shipped out of Florida will occur between now and the 28th of March. It's about 20% the way through. It culminates in the 10-day Florida Strawberry Festival in Plant City. And that event marks the start of the Florida spring produce season and the national produce season. As temperatures get warmer, produce moves further south to north. So right now it's the start of the produce season nationally. South Florida volumes are up 20% week over week. 3-day spot rates are moving up quickly. On the benchmark lane that I look at for produce, Lakeland to Brooklyn, Hunts Point produce market, spot rates at $2.64 a mile and increasing. That's including the fuel surcharge. It's also peak shipping week, as Ken mentioned. For Valentine's Day this Sunday, about 91% of all fresh cut flowers arrive in Miami. 3-day rates from Miami to Brooklyn are paying 14 cents a mile higher this week, and higher than the Lakeland market for strawberries. So rates are up to $2.78 a mile and bumping up on $3.15 for some loads. That'll probably continue escalating as we get closer to the end of the week. In the flatbed sector, top 10 markets, volumes increased 5%. Capacity was fairly flat. Rates only increased about 1 cent per mile. So not a lot of change there in the flatbed sector. Jumping over to the dry van spot rates year over year summary to wrap up this week's market update. Rates, as Ken mentioned, found some support around the $2.05 level. They'd been on a bit of a successive week over week drop all through January. They're still up 54 cents a mile compared to the same week in 2020 when they were $1.51 a mile. In the refrigerated space, they ended the week pretty much where they started at $2.27 a mile. It's still 47 cents a mile higher than the same week last year when they were $1.80. And in flatbed, rates remained largely unchanged at $2.19 a mile. And they've been in this sort of $2.20, $2.15 to $2.22 range for about 4 months now. Not a lot of change since October. So that's it for the market update. If you want to find out more about what we've covered today, go to DAT.com/market update, and you can get all the latest information there. Over to you, Ned.
All right. So I'm actually kind of disappointed that we didn't get to show our forecast last week because as you're about to see in the forecasts coming up, I think that RateCast did a pretty good job last week. So, but let's kind of roll ahead. So first we're going to talk about the national spot van forecast. So here you can see in blue is the market rate measured by DAT in the past. And then off to the right, we have our forecast for RateCast in green, for our short-term model in red, and for our two blended forecasts in gold and silver. Those blended forecasts are mixtures of the two models in different amounts and in different ways. And one of the things you might notice here is that it's really hard to tell the models apart in this particular chart. They're all just right on top of each other. Having broad model agreement is something that I like to see. It typically means, generally speaking, that there's not a lot of unforeseen stuff that's going on. If the short term and the RateCast model are in alignment, I tend to like that better. And unfortunately, we didn't get to show you last week, but last week the short term model was kind of chicken littling a little bit, whereas the RateCast model was expecting there to be some leveling off, and lo and behold, there's some leveling off. So I like the short term model.
To that, I'm just gonna I'm gonna challenge that first, not challenge
sure,
long term, but
sure.
I'm just gonna say something.
Yeah.
This is kind of, I mean, they're kind of in agreement that it's kind of a punt this week. Is that fair?
Yes. Yeah.
Right, because we've reached a support level, and there's really there's no strong signal around whether we're going to breach that on the downside or start to recover on the upside. Is that also a true? I'm genuinely asking.
Yeah.
Because I'm looking at this.
No.
For the first time myself.
I think that's pretty accurate. There is definitely some, there's downside risk. Like we've said before, there's a lot more downside risk than there is upside risk, just due to like the fundamentals of the freight market. But for right now, there's nothing strongly pushing it one way or the other, and they're both kind of expecting things to hang out here. I don't expect that things are going to keep hanging out here. I think that probably something is going to change, but that's kind of the most boring possible forecast. Things will stay the same until they change. But I feel like it's pretty accurate in this case. Moving on towards the what's next in our reefer forecast. The reefer forecast, again, you can see the DAT measured market rate in blue, the rate cast rate in green, the short-term rate in red, and the silver and gold blended forecast. And here, rather than it being completely flat, there's a little bit of downward pressure. I'd say maybe like, 3-4 cents over the course of the next month. But again, there's kind of broad model agreement. There's not a lot of what's going on, but they're expecting for at least the near future for things to kind of continue as they are, with maybe a tiny bit of slide. But it'll be interesting to see what the big cold front is going to do to reefer rates if it keeps up. Finally, we're moving to flatbed. Flatbed is actually a little bit different, not hugely different, but a little bit. So that's, again, DAT measured market rates in blue, the rate cast rate in green, the short-term rate in red, and the blended forecast in silver and gold. And here you can see that there's some kind of seasonal wiggles, but there's a little bit of upside. I'm going to say about 3 cents of travel positively over the next month. Flatbed really seems to like this particular rate, and there's a little bit of model disagreement, but not enough that I'd really call it out. Do you have any more comments on that before we move over to our DAT IQ question of the week?
I think so. For folks maybe newer to the industry or kind of following the industry on a more cursory level, why would you want to ship refrigerated when it's cold outside, Dean?
Well, Dean, yes.
Typically, I did some studies on this over the last few years, and there seems to be a relationship between at about plus 7 degrees. So as temperatures drop, what happens to dry freight that typically moves in dry vans, it has a propensity to explode when it gets too cold. So you can think about soft drinks, detergents, all sorts of things in plastic containers, even beer, for example. So what happens is a lot of refrigerated trucks are used to keep freight warm and stop it freezing, as opposed to keep it cool during the summer. So it's kind of the reverse effect. And some trucks are equipped with all sorts of blankets that cover the loads. There's a premium that goes along with that sort of specialized equipment, but that's generally why. It's to simply keep freight that would normally move in a dry van from freezing during transit.
Yeah, reefer is kind of a misnomer, right? We tried whenever I was in industry to refer to it always as temperature controlled, more so than just reefer, because there's a very big demand for keep from freeze.
Yeah, no, there's
sorry, Ned. Sorry to interject there.
No, but there's a fun story about that. Just to digress, I have some friends from Alaska, and they always talk about having to store a lot of their dry stuff in their fridge because of that same thing. It just gets too cold, and so they use their fridge as kind of a heat preserver. So it's the same principle. Anyway, let's get to our DAT IQ question of the week, which is, according to what I have here, what are we seeing in the RFP market for this fall?
Well, that's actually not correct. That's a groundhog.
That is not correct. Okay. All right.
It is. What impact do rising fuel prices have on freight? Which I think was a timely question last week, and I think it's even more timely this week. And for that, our resident expert on how fuel prices impact truckers, Dean, is going to take it away and kick off the discussion.
Yeah, I did some modeling on this using the a wider spreadsheet that they have on their website that has all the operating costs, so you can do some what-if scenarios. And of course, today I just noticed diesel is still up. It's gone up again to $2.80. this morning. West Texas Intermediate oil is up to about $58 a barrel. So it's up. It's for the first time, it's up about $4 a barrel higher than pre-pandemic levels. So oil prices are going up. That's sort of dragging diesel prices up with it. And of course, there is some expectation that that'll increase through the summer like it normally does. But what I did is I went and compared this week with the same week in 2020 and looked at the rate per mile back then, which was $1.52 on the spot market, excluding fuel, compared to $2.03 today. So rates are actually 51 cents a mile higher, but diesel is 26 cents a mile lower. And because diesel represents about a third of your operating costs, it has a significant impact on your profitability. So let's compare rates at 152 versus 203, and then let's contrast that with diesel prices of 306 this time last year versus $2.80 today. Now, I'm running 65 miles an hour speed limited. I'm running 2250 miles per week. So I'm running around 110,000 miles a year, of which 10,000 is empty. So I've got 100,000 loaded miles, 10,000 empty miles. I've got a truck payment. I'm paying off around $1,700 a month for truck and trailer, and I'm paying myself $50,000 a year base salary. So everything else stays the same. The only difference is the rate per mile and the diesel cost. So this time last year, you'd have been losing 15 cents a mile. Operating costs were $1.53, all up operating costs. But you'd actually been losing your revenue. Gross income per mile was about $1.39. This year, your gross income per mile is $1.85. So you're actually making 46 cents a mile more this year because rates are so much higher. In terms of expenses, the diesel costs dropped operating costs down about 4 cents a mile. So to sort of sum up the difference between last year and now, this time last year with lower rates and higher fuel, you'd have been losing 15 cents a mile. This time you're making 36 cents a mile on the positive side. So there's a lot more room to go in terms of where diesel prices could go. But right now, carriers, especially on the spot market, are making pretty good margins. That's paying yourself $50,000 a year. Earnings before interest and tax are up around $55,000. That's after paying yourself a $50,000 salary. So right now, gross profit per mile is about 50 cents a mile based on spot rates at $2.03 and fuel at $2.80.
Yeah, I mean, it's a great overview, and I think a couple other bits. Now I think is a good time to review all the fuel, especially if you're dealing a lot with the shippers direct. Review the fuel surcharge programs. There's a big difference between $1.25 and $1.50 in the peg rate, or they all call it different things, peg rate or the base rate, things like that. Mm-hmm. What's the assumed mile per gallon? Mm-hmm. What would you say is the most common, Dean? Was it like $1.25 and 6.5, or $1.50 and 6.5?
I would say $1.25 and 6 is where I would land.
Okay.
I noticed some companies
all combination.
Yeah, higher. Yeah.
The government's the worst. I think they're like $2.50 a mile base. It's kind of a wild.
Right.
And there was zero fuel surcharge there for most of 17 and 18. Ned, did you have anything you wanted to add on the fuel side?
Well, forecasting fuel is tricky. And I mean, that's one of the things I want to call out, that our ratecast forecasts don't include fuel. So if you're using those to base your RFPs or just like your expenses on, I would definitely remind you that we don't forecast fuel currently. That's something we're looking into doing, but be aware of that. The other thing that I thought was really interesting about what Dean had to say was the way that costs were kind of split out, right? Like when diesel is as low as it is, because that's a huge function of your operating costs, there's going to be a lot of room for you to operate kind of inefficiently, I guess. And the market can turn pretty quickly. And so trying to make sure that there's not like a repeat of, 2019, 2018, when a lot of folks gotten some hard times because the costs turn so rapidly. I think, right. You want to get your windfalls, but not count on it.
And I think part of it is that there's a natural sort of flaw around how low you can go to operate a truck successfully without sort of getting into too much trouble and running negative cash flows. I think, at these rates around $2.03 a mile, that's not a stellar living in terms of, salary and, for the time you've got to spend out on the road and away from home. There's a lot of unpaid time that goes into those numbers. So it's a living, but it's a pretty tough one. But at least this time now, with rates where they are, if they stay around this level, then carriers should be able to maintain some profitability through this year and avoid some of the things we saw last year with a lot of bankruptcies earlier in the year.
Yeah.
Yeah, I mean, the market doesn't care what the cost to operate is. I think that's the in my opinion, the fatal flaw of some of the newer rating methodologies we see cropping up on the market. Right? They'll project, LA to Dallas at $1.60 with a 1 year forecast of like 81 cents. Right? Just that doesn't rationalize with what's happening in the market, because the market doesn't care. It's a supply and demand driven market. I mean, there are basic forces, right? So just like with energy, if the cost of natural gas goes below a certain level, people will stop producing. Therefore, it'll dry up the supply, and the price will naturally increase. But it's not a direct function of the cost, right?
Yeah, no, but the timetable on that is pretty long, right? Like, it's not that kind of adjustment isn't instantaneous, and there's a lot of pain that can be caused. To your point about the natural gas.
Yeah, I mean, going back to forecasting fuel, that's another kind of tip, and I'll be fully honest and say DAT is not perfect in this sense. I'm trying to rectify some of this. We present some numbers with fuel and without fuel, but I do think we do a pretty good job of disclaiming it as such. So when you're seeing competing market metrics out there, even broad market metrics, just be sure that you're comparing apples to apples, so numbers with and without fuel. We believe, at least in this virtual room, that showing line haul only is the best way to capture what the market's doing, because right now you'd be artificially having a rosier picture than what the line haul rates are showing, because fuel would be giving you stark inflationary lift, if you will. So with that, I think we're going to turn it over to questions. And again, I'll repeat the call. If you have any questions, drop them in the chat below. We're willing, since we skipped last week, we're willing to stick around a few extra minutes if the questions do roll in. I know we already have a few, so I just wanted to put that out there. I'll turn it over to Ned to be our official question reader.
Ooh. Woohoo from Texas Harris asks, how's Expedite going?
The folks that I know, having been in the Expedite industry, or at least adjacent to it for 7 years, say bad. So let's split it into a couple pieces. If you're serving, Expedite was created effectively to serve the auto industry, right? Not doing so hot. They also serve industrials in line down situations. Again, not doing so hot. If you're in the white glove Expedite, right? So you're handling pharmaceuticals, medical devices, pharmacological products, even over-the-counter stuff, you're probably doing okay. I haven't heard much disruption on that side, especially with COVID and the enhanced need for medical supplies, devices, PPE, stuff like that. But the pretty much mainline Midwest Expedite is the volumes are down considerably, unless you've heard anything different, Ned or Dean.
Nope. We have a question from Stefan. If we expect truckload rates to decrease as volumes normalize and more capacity is added to the market, would we expect another wave of carriers filing for bankruptcy similar to 2019?
It's entirely possible. That's sort of the market cycle that we've seen in the last couple of years with the overcapacity situation in 2019 after 2018. That's kind of my worst case scenario, is that we see too much capacity in the market and demand doesn't rise as to sort of meet the level of supply that's going to be entering the market. So that's part of the reason I said that provided rates stay around this sort of floor that we're seeing right now, around $2 a mile, carriers should be pretty good. But if diesel goes up to $3 a gallon and we're back to, that sort of low 150 mark, then we're back where we were this time last year, and carriers would be losing money again. So it's entirely possible. But again, this is such an unprecedented time. It's hard to say how quick demand ramps up, given where we are with the pandemic and the vaccination rollout that we've got underway right now.
I have kind of a morbid question, Dean, if you're willing to entertain me.
Okay.
How long can a carrier sustain negative cash flows before they go bankrupt? Is this the kind of industry where people are really willing to take out loans and keep the business going, or I don't know?
Well, so it's a great question. This time last year, carriers were availing themselves as PPP1 loans. So that was sort of a bit of a buffer that they were able to use when rates were down around $1.50 back in April. I suspect that'll be the same for carriers that are really hurting, where their commodity they haul has been affected by the pandemic. So normally, given lack of economic stimulus, maybe 1 to 2 months at most. A lot of it, you have some pretty big expenses every month in terms of fuel and repayment. In normal times, financiers aren't generally that flexible. This time last year, if you think about, I looked at some, the inventory data at auctions. It quadrupled in June last year, which was a month after rates bottomed out at $1.50. So there was a lot of Class 8 trucks that went out of the industry, and then rates increased and they came back into the industry. So I think it's probably on a 4 to 8 week cycle in terms of how long people can last.
Carrier is kind of a broad sense, right, Ned? I mean, I know personally, I've talked with probably hundreds of carriers that are, biweekly truck payment. They don't really understand the finances of running the truck, and that truck's back with the dealer or the finance company within 2 or 3 payment cycles, right? Larger carriers, I would say, like large enough carriers to have an accounting person or accounting department. I mean, you're banking 2 consecutive quarters of high 70, low 80% ORs. I think the thought there is that as long as you don't overinvest in capacity this quarter and next, you should be okay through the cycle. The numbers just came out. It was in the Wall Street Journal. I think it was Broughton's numbers, or was it Broughton's numbers?
Yep.
For the trucking bankruptcies. I was surprised, right? Because we tend to lump all of 2020 as this great year for freight, but Q1 and Q2 were pretty gnarly, and those numbers reflected it.
Yeah. Same as 19, though. I think that was the same thing. Q2 in 19 was pretty bad also for bankruptcies.
Yeah.
Robert asks, yes, for every penny more per gallon, this is a nice tip, is $1 extra for every 100 gallons of fuel. So if fuel is 50 cents more, that is $50 more for a 100-mile trip.
Yep, correct.
I like that.
Yeah. No, I mean, I think that I'm not sure how many small carriers are watching this show, but I think that one of the advantages of this kind of a format is that we do have a lot of information that I think is helpful to smaller carriers that can be hard to get otherwise. And so I hope those of you out in carrier land are listening.
I mean, it's a big push for us both, because we care about the industry and sort of commercially even, right? It's how do we get the same information that, previously only the top logistics firms in the world had access to into the hands of a single owner operator. There are tons but there's tons of innovations, technological innovations. The fact that you have a computer in your hand at all times has made that easier for us to be able to do that. So I'm really excited about some of the stuff that we've already released, the DAT1 app, and kind of our future there, to really getting that data into the hands of the people on the front lines using it. Because I do think it helps make better business decisions, not just for large multinational firms. It's an army of one sometimes.
We have another question from Woohoo from Texas Harris. What is the update on electric semis? We were just talking about this morning before the show started.
I mean, some of the big OEMs are releasing some new trucks this month, in fact, that have got the battery powered vehicles. So I think with this year we're going to see a lot more of them out on the road in beta stage. The new administration is certainly going to be very pro alternative power sources. So I think it's a case of let's wait and see what the next infrastructure bill looks like. Once that gets through, assuming that happens, what we'll see is a lot more infrastructure being built, especially around hydrogen. Those hydrogen-powered battery cells will be much better for the long-haul sector because they can last a little bit longer, but you can fill up much quicker. But there's a lot of infrastructure to be built around that. I think infrastructure is going to be the biggest issue, not so much the actual truck building side at the OEM level.
Yeah, no, that's a lot of investment to be able to like replace every service station in America.
Right.
Sorry, you were saying, Ken?
I'd be interested, like if we could snap our fingers and get Jimmy Haslam on the phone from Pilot Flying J. I'm curious what he has to say about that. We have a couple more questions coming, so Do you mind, Ned? I don't think everyone wants to see me squint. And Monica's been yelling at me to sit still because my mic is rubbing against my sweater.
No,
so I'm
yeah,
trying to sit as still as possible.
Absolutely happy to handle them. Monica was starting to motion towards the door. Stefan asks, what would you consider to be a healthy OR for truckload carriers?
I love this question. 75 in perpetuity if you'd ask the CEO of just about any large trucking firm, right, Dean?
Yeah, absolutely. Typically, it's been much higher, right, for years. I know some fleets right now are running those sorts of ratios, but for decades, they were sort of in that low to mid-90s range.
I mean, healthy is a super objective term. I think the industry is self-sustaining at probably 93 to... I mean, it all depends on, like, OR is just one piece of the puzzle, right? Income statements are super sensitive to driver turnover, and some of the best are promoting their dock workers to probationary driving programs and paying for the schools, and the cost of acquisition per driver is much lower. You're bringing in drivers at a much lower tenure and paying them less to start because you've comped their school and they tend to stay and not turn over as much. But probably 93 to 95 is what most large, heavy asset terminal, hub and spoke even run at. I think when you're pushing into the 80s, it's a high 80s. It's a banner year for sure. But I mean, 75 is just generational, I would say. I'd have to go back and check myself. I'll fully admit that I could be very much proven wrong on here. And anyone in the chat who knows or wants to do the research can very much call me out. But I don't know that 75 happens but once or twice a generation.
Right.
Think about that, right? You're making 25% in an industry that you're clawing to get to double digits most years. So it's all about banking that too, and using that windfall as a cushion for the future when times. I mean, it's just an oscillating industry for sure.
We have a question from David. Would you recommend dry van or reefer to start for an owner operator? Dean, I feel like
I'd as a personal preference, I'd go with refrigerated. I'd take the weight penalty for more flexibility and be able to pull more loads both through summer and winter. I think it gives you more flexibility in terms of what type of loads you can haul in more markets as opposed to dry van. But I've had more experience in hauling refrigerated freight than anything else, so that's sort of, I'm biased that way. That said, there's a lot of demand for dry van freight with lift gates right now for final mile sort of regional freight. So I think maybe seasonally there's a strong case to be built around any sort of freight in that e-commerce, retail, consumer packaged goods space right now. But sort of over the longer haul, my experience has been that I could pick up more loads if I had the fridge motor on the front.
The one thing I would add, having never driven a truck, so my advice following up Dean's is rather considerably worse, I'm sure. Understand some of the things you're going to be getting yourself into, right, with a reefer. The USDA regs, some of the insurance, some of the cargo claims liability stuff isn't as straightforward, right? So, if you show up and with a truckload of cabbage, that's temperature controlled, and you get turned away because it was temperature excursion, or your reefer ran out of fuel the last 100 miles or something, you could be writing off the entire trailer worth of freight. And those are just some things that I would caution, especially if you're super new to the industry. Swapping out a trailer is a lot easier than going to buy like a 28-foot straight truck with a refrigerated unit on it, that costs $340,000. Is that bad advice, Dean, or is that,
no? I think it's good advice. I was thinking about one of my worst experiences with a cargo claim where I picked up a load of cantaloupes at a farm in Australia, and it was 100 degrees ambient, and they didn't have it in the cold store, and they said, we want you to run it at plus 30 all the way into Sydney. And I said, I can't pull 70 degrees out of 24 tons of cantaloupes. But I did, and the trick is you've got to pull it down in 5-degree increments and stop every hour. So I eventually did it, but the downside was if I'd have turned up at the market without the right temperature set and probe readings, they'd have turned the load away, and it would have been a multi-$1,000 claim on my hands.
Jeez. Were they cantaloupes or muskmelons?
Well, they're actually called rock melons. They're called rock melons in Australia. I converted it here because no one knows what rock melons are, apparently.
Apparently they don't know what cantaloupes are either. All right, before we go off on a fruit tangent here, I'm going to wrap us up. So I want to thank everyone for joining us and bearing with us through our tech difficulties. Like I said, it's only going to go up from here. We have some really exciting interviews and long-form conversations coming up over the next few weeks. Check out Dean's Market Report on our website. Check out Chris Caplis's Freightbind podcast. New year, tons of great guests on that. Great insight. And with that, we'll sign off this week, and we'll see you next week, Tuesday at 10. And we look forward to talking then. Thanks, guys.
Bye.